You know how on ancient maps, the edges of the known world were just blank space.
Oh, yeah. Like the giant sea monster.
Exactly. The map makers would literally draw a terrifying sea monster and write like, here be dragons. And honestly, for the longest time, that is exactly how traditional finance treated the crypto markets.
Right.
It was this wild, untamed frontier right at the edge of the financial map. And serious people just did not venture into it.
No, absolutely not. I mean, it was viewed as dangerous,
Right.
deeply misunderstood, and honestly fundamentally incompatible with the super strict compliance departments of legacy banking.
Yeah.
The institutional mandate for the past decade was essentially just quarantine, stay away.
But, okay, look at the landscape today. Wall Street hasn't just crossed into that territory. They've rushed in with fleets of bulldozers and Army Corps of Engineers and GPS satellites. They were actively trying to pave and own every single square inch of it. So, welcome to the deep dive. For you, the curious learner, trying to cut through all the absolute noise of the daily financial news, that's exactly what we're doing today.
Yeah, we are pulling out the map of May 2026 to see where the roads are actually being built.
Right. And our mission today is to unpack a really fascinating stack of sources. We've got excerpts from the Crypto.Report newsletter from May 11th, 2026, alongside market summaries from top YouTube influencers like Altcoin Daily and Josh Olszewicz.
And the landscape we're looking at, it's defined by a massive inflection point.
Oh, massive.
Because it's not just that Bitcoin is holding this incredibly strong floor above $80,000. I mean, that's the headline.
Right.
But underneath that, we are seeing a structural shift. Capital is rotating out of crowded tech trades. Institutions are just accumulating digital assets at a pace we haven't seen before.
And the government, right.
Exactly. The United States government is on the verge of passing legislation that will permanently alter the DNA of the digital economy. What's fascinating isn't just the price, it's who is buying, why they're buying right now, and how these new rules change the game entirely.
Okay, let's unpack this, because to understand this $80,000 market, we really have to look at the macroeconomic forces pushing the capital around.
Yeah, follow the money.
Right. Money doesn't just spontaneously generate, it moves from one place to another. And if you look under the hood of this market rally, the capital isn't just coming off the sidelines.
So it's actively rotating.
Exactly. We are seeing money actively siphon out of heavily overbought tech sectors. Places like the massive artificial intelligence and semiconductor trade.
Like NVIDIA.
Which dominated the last few years.
Yeah.
According to Josh Olszewicz's analysis, that capital is flowing directly into Bitcoin and very specific altcoins like TON, OENDO, and SUI.
And the mechanical strength of this rotation is highly visible in the technicals. Like market analysts tracking this highlight that Bitcoin is holding firmly above the Ichimoku cloud.
Okay, wait. For anyone who doesn't spend their day staring at candlestick charts, what exactly is the Ichimoku cloud?
Right. Fair question. It's essentially a visual baseline for market momentum. It takes multiple moving averages and creates a literal, shaded cloud on the chart.
Oh, okay.
And as long as the price stays above that cloud, the overarching trend is decidedly bullish.
Yeah.
And right now, it's pointing toward a target well over $100,000, assuming this momentum holds.
Wow. Okay, but here is the part that I find genuinely surprising from the sources. Despite Bitcoin sitting above $80,000, the funding rates across the major exchanges remain really low.
Yes.
Now, I know that sounds like incredibly dense trading jargon, but I want to unpack why this specifically matters to you, the listener, because you might be trying to figure out if this entire market is just another giant bubble ready to pop.
Well, funding rates are arguably the most important metric for gauging the health of a crypto rally.
Really? Why is that?
Because they essentially measure the premium traders pay to borrow money to place leverage bets. When funding rates are sky high, it means the market is driven by pure euphoria.
Right. Just gambling.
Exactly. Traders are borrowing massive amounts of money to gamble that the price will keep going up. It creates this fragile house of cards that collapses the second the price dips.
I see.
But low funding rates, combined with a rising price, tell us the exact opposite. This isn't leveraged gambling. This price action is being driven by sustained, fundamental spot buying.
Spot buying. So real cash buying the real underlying asset.
Precisely.
And a massive chunk of that real cash is coming straight from traditional finance. Look at Morgan Stanley. They launched their spot Bitcoin ETF under the ticker MSBT. And during its first month of trading, this fund attracted nearly $194 million in inflows.
Which is huge.
And it did that without recording a single day of net outflows.
Okay.
Every single day, the pile just got bigger.
Yeah. That is a staggering metric for any newly launched financial product, let alone a digital asset fund operating inside a legacy wirehouse.
But the underlying detail from the report is what makes this so crazy to me. Almost all of those inflows came strictly from self-directed Morgan Stanley clients.
Right.
The bank's actual army of financial advisors, the wealth managers who actually guide the massive client portfolios, they haven't even opened access to the product yet.
It's all organic so far.
Yeah. It's like a highly exclusive five-star restaurant
Yeah.
pulling in millions of dollars during a quiet, soft opening, right? Before the general public is even allowed to pick up the phone and make a reservation.
That's a great way to put it. The pipeline is built, but the main valve is still bolted shut. Wealth management platforms at these legacy banks, they require months of internal due diligence before they allow advisors to actively solicit a new product.
They're just waiting.
Yeah. Once those financial advisors are finally unleashed to actively recommend this ETF to their high net worth clients, the inflows could accelerate exponentially. We are looking at the initial trickle before the dam opens.
Okay, but Wall Street ETFs vacuuming up Bitcoin is only half the institutional story here, because this tidal wave of traditional money is mirrored by how massive corporate treasuries are treating the asset. We have to talk about the corporate megalodon in the room.
Oh, yes. Strategy.
Yes, the company referred to across the market simply as Strategy, led by Chairman Michael Saylor.
So Strategy currently holds over 818,000 Bitcoin on their corporate balance sheet.
That is insane.
Right. At current market prices, that is a corporate treasury worth over $66 billion.
$56 billion. Now, the market has been holding its breath a bit regarding a very specific date coming up.
Right.
May 15th. That is the ex-dividend date for Strategy's STRC preferred stock program. And for anyone unfamiliar, preferred stock pays out a fixed dividend to investors. So there was genuine panic brewing that Strategy was going to have to start dumping their Bitcoin on the open market just to generate the cash to fund these dividends.
Which is a completely rational fear. I mean, if a whale holding $66 billion of an asset starts liquidating to pay dividends, it can cause a cascading price crash.
Exactly.
But Michael Saylor had to come out and publicly clarify the company's position. And the math he presented is it's a masterclass in their long-term thesis.
What did he say?
He stated that even if they occasionally sell a tiny fraction of their holdings to fund these specific dividends, for every one Bitcoin they sell, they aim to buy 10 to 20 more.
Okay, wait. I have to push back on the sheer audacity of this math. Let me get this straight. They're selling their core asset to pay out corporate dividends, but instantly turning around and buying 10 to 20 times more of that exact same asset.
Yeah.
That's like taking a single cup of water out of a swimming pool to give someone a drink, and then immediately backing up a municipal fire truck to blast water back into the pool.
Yeah, pretty much.
How does a publicly traded company justify that kind of aggressive accumulation to their shareholders? Like, where does the money for the fire truck come from?
I know, it sounds like a paradox. But until you look at the mechanics of corporate finance, which Strategy's CEO, Phong Le, explicitly detailed.
Okay.
In traditional corporate finance, you have a weighted average cost of capital. If Strategy needs cash, they basically have two choices. Sell some of their pristine asset, which is Bitcoin, or issue new stock and dilute their current shareholders.
Right. Nobody likes dilution.
Exactly. So Phong Le stated that Bitcoin sales would only ever happen if it drastically improves shareholder value compared to that dilution.
So it's a highly calculated arbitrage play.
Precisely. Strategy is no longer just a software company passively holding Bitcoin in a digital vault. They are actively engineering complex financial products around it. They're utilizing their massive Bitcoin treasury as pristine collateral to generate yield, issue convertible debt at incredibly low interest rates, fund operations, and just aggressively acquire even more. Analysts project they could buy another $30 billion worth of Bitcoin this year alone.
$30 billion.
Yeah, they have permanently positioned themselves as a net accumulator.
Which brings up a really important question for you listening. What gives a $66 billion corporate treasury and legacy banks like Morgan Stanley the sheer confidence to go all in like this?
It's the rules.
Right. Because traditional finance hates risk. They hate dragons on their maps. They demand certainty. And the answer to where that certainty is coming from is currently unfolding on Capitol Hill.
Yep. The big money is finally moving because the official rule book is finally being written.
Exactly. According to Altcoin Daily, on May 14th, The Senate Banking Committee is scheduled to review and vote on the Crypto Clarity Act.
This is huge.
And this isn't just some minor regulatory tweak, right? This is positioned as the first comprehensive, full U.S. regulatory framework for the entire digital asset market.
The implications of this cannot be overstated. Clear federal rules act as the master key that unlocks widespread institutional integration.
Right.
We aren't just talking about Bitcoin anymore. This legislation specifically targets the broader financial infrastructure layer: Ethereum, stablecoins, decentralized finance, and the tokenization of real-world assets. Coinbase is predicting this will unlock massive institutional adoption.
And the timeline is apparently accelerating. Former President Trump is reportedly pushing for the bill to be signed before July 4th.
Yeah.
Now, real quick, a mandatory impartiality note here.
Yes.
We're absolutely not taking political sides or endorsing any politician. We are merely reporting the source's analysis. Regardless of who is in office or what side of the aisle you sit on, the market doesn't care about the politics. It only cares that bipartisan alignment acts as a massive psychological and financial catalyst.
Exactly. Markets price in uncertainty as a discount. Once the uncertainty is removed, the asset's value adjusts to match its actual utility.
Imagine trying to price a massive piece of commercial real estate. Right. But the city won't tell you if the land is zoned for a 100-story skyscraper or a toxic waste dump.
That's a massive risk premium.
Exactly. The Crypto Clarity Act is essentially the city finally publishing the zoning laws. Or, imagine playing a high-stakes sport for 15 years where the refs change the rules every quarter. This act is the league finally publishing an official rule book.
Right.
So I want to connect this back to something we touched on earlier regarding the rotation of capital. Ethereum and altcoins have been lagging behind Bitcoin for months. How does this incoming rulebook change that dynamic?
Well, if we connect this to the bigger picture, Bitcoin already received its regulatory clarity earlier this year with the spot ETFs. The market knows legally that Bitcoin is a commodity.
Right, that's settled.
But Ethereum, altcoins, the entire DeFi sector, they've been living in this suffocating legal gray area. Are they securities?
Yeah.
Commodities? The Clarity Act specifically de-risks this secondary layer.
Which explains the technical signals flashing across the market right now.
Yes. Market analysts are pointing to a bullish MACD crossover for the broader crypto market.
What's a MACD crossover?
It's basically a momentum indicator that tells traders a short-term trend is accelerating past a long-term trend. It signals a massive incoming wave of buying. The rotation into altcoins we discussed is happening precisely because traders are front-running this regulatory clarity.
They're placing their bets before the rulebook is officially bound and published.
Exactly.
But, while the Senate debates the theoretical rules of digital finance, the actual technical infrastructure operating right now is still a highly experimental and sometimes incredibly dangerous frontier.
Oh, absolutely.
And the urgent need for vastly better infrastructure was violently highlighted by a massive exploit just this month. Let's talk about the $292 million Kelp DAO exploit.
Executed by the Lazarus Group.
Yeah, which is widely known to be tied to North Korea. And the social sentiment surrounding this event was absolutely catastrophic. It's centered around a bridge protocol called Layer 0.
You a mess.
After weeks of intense public criticism, Layer 0 finally came out and apologized, admitting their communication was terrible, especially considering that immediately after the hack happened, they actually claimed the protocol had, quote, worked as intended.
I mean, hearing a developer say the system worked as intended while nearly $300 million vanishes, that is a terrifying prospect for an investor.
Right. But the technical admission is what really exposes the fragility here. They admitted they allowed a security setup that relied too heavily on a single verifier.
Yes.
And Lazarus manipulated this infrastructure to fake cross-chain transfers, making them look completely legitimate, and systematically drain the Tarthith tied to Kelp DAO. Now, hold on. I'm getting fired up about this.
Go.
If the entire fundamental ethos of this industry is that it is decentralized and trustless, how does a system with a single verifier ever get approved to handle hundreds of millions of dollars in the first place? Isn't that just a centralized bank with infinitely worse security?
It's a completely valid frustration. And honestly, it exposes the growing pains of decentralized finance. But to understand how this happens, we have to look at the immense technical difficulty of cross-chain bridges.
Okay, walk me through it.
Blockchains like Ethereum and Arbitrum do not naturally speak the same language. Think of a cross-chain bridge like a border crossing between two countries.
Okay.
The verifier is the customs agent translating and approving the transfer. Layer 0 allowed setups where there was essentially only one customs agent working the booth.
And Lazarus just bribed or compromised that one agent.
Exactly. They compromised that single point of failure and simply forged the paperwork to print money on the other side. And what they stole was RCETH.
Which is what exactly?
It's basically a receipt token. When you lock up your Ethereum to help secure the network and earn yield, you get RCETH back as a liquid receipt that you can still trade.
Oh, wow.
So when Lazarus drained the RCETH, they were stealing the liquid receipts to hundreds of millions of dollars of underlying locked value.
That's devastating. And the reputational damage to Layer 0 has been immense, right?
Yeah.
Major projects are actively abandoning them and migrating over to competitors like Chainlink's CCIP network.
Yeah, because Chainlink uses a much more robust, decentralized Oracle network. Instead of one customs agent, an Oracle network requires a massive decentralized committee of independent nodes to verify off-chain data and approve the cross-chain action.
Much safer.
Layer 0 has since completely banned single verifier setups, but, the market has already lost trust.
Well, the response to the hack, however, presents a massive silver lining. It wasn't just panic, it was coordinated action. A major decentralized lending protocol, OLV, actually stepped in and managed to liquidate the attackers' positions on their platform.
Which is incredible.
Right. They took the recovered collateral and immediately redirected it into a recovery process. And then, distinct separate communities, Arbitrum and the Mantle DAO, actually held governance votes and approved support measures to help restore the financial backing of the stolen RCETH.
And this raises a vital point for you, the listener, trying to understand the maturity of this market. Yes, the vulnerability was a catastrophic failure of design, but the response, that is profoundly bullish for the industry's evolution.
How so?
Because what you just described, RV, Arbitrum, Mantle DAO, acting together without any central authority forcing them to do so, is essentially a decentralized immune system activating in real time.
Wow, an immune system. I like that.
It is historical first for decentralized governance to coordinate a financial recovery of this scale across totally different protocols.
He protected the ecosystem themselves. But, building and maintaining that kind of decentralized immune system requires immense physical computing power. And that brings us to the strangest plot twist in this entire ecosystem.
The miners.
Yes. The companies powering this blockchain infrastructure are suddenly realizing their hardware is valuable for something entirely different. Look at the mining company TeraWulf.
TeraWulf is one of the largest publicly traded Bitcoin mining operations in the world.
Right. But according to the latest data, for the first time ever, TeraWulf generated more revenue from artificial intelligence hosting, providing high-performance computing infrastructure, than they did from actually mining Bitcoin.
It is a remarkable and highly lucrative pivot.
Wait, are you telling me that Bitcoin miners who have spent billions building these massive energy-intensive data centers to solve cryptographic hash puzzles are going to accidentally become the physical backbone of the AI revolution?
No, it's wild, but it makes perfect sense when you look at the physical constraints of artificial intelligence.
Okay.
Training AI models requires massive data centers, specialized cooling systems, and access to gigawatts of incredibly cheap electricity. Bitcoin miners have spent the last 10 years solving those exact three problems.
Oh my gosh, you're right.
They already have the land, the power purchase agreements, and the industrial cooling infrastructure. Now, they are simply swapping out their Bitcoin mining rigs for high-performance GPUs because AI companies are willing to pay an absolute premium for the hosting space.
That creates a fascinating paradox. The retail traders and hedge funds on Wall Street are rotating their capital out of AI stocks and into crypto assets.
Yep.
But simultaneously, the actual physical infrastructure companies of crypto, the miners, are rotating their hardware into AI hosting because it generates a higher yield. It's an incredible convergence of the two biggest technological narratives of this decade.
And traditional money sees this infrastructure convergence happening. They are building the permanent rails to support it. Look at the institutional expansion.
Yeah, the sources mentioned a French firm, Capital B, raising $18 million backed by early crypto pioneer Adam Back, specifically to expand their institutional Bitcoin treasury. And we have a company called Digital Asset raising $300 million, targeting a $2 billion valuation, specifically to expand institutional blockchain adoption through their Camden network. The legacy financial world is digging in deep.
They are laying the concrete foundation for the next 50 years of finance.
But amid all this corporate maneuvering, massive AI data centers, and regulatory rulemaking, the data threw in one tiny, almost spooky headline. a ghost from the past.
The whale.
Yeah, a dormant Bitcoin whale wallet, meaning a massive holder who hasn't touched their coins in over a decade, just woke up. A wallet from 2013 just moved 500 Bitcoin. That is $40 million, shifting on the blockchain after 12 years of absolute silence.
It is always striking when the ancient cypherpunk history of the blockchain suddenly interacts with the hyper-financialized present day.
So what does this all mean for you? Let's zoom out. In just this short deep dives, we've tracked a massive evolution. We started with the raw data, Bitcoin firmly holding its ground at $80,000,
Right.
driven by sustained spot buying rather than leverage. We saw Wall Street's quiet, methodical hoarding through Morgan Stanley's one-way ETF inflows. We looked at the impending May 14th Crypto Clarity Act, promising to finally give this industry a federal rulebook and remove the massive risk premium holding back decentralized finance.
Exactly.
We confronted the harsh $292 million reality check of the Kelp DAO hack and saw a decentralized immune system fight back. And finally, we witnessed crypto miners literally morphing into AI data centers to survive and thrive.
You are witnessing in real time the complete financialization and maturation of a fundamentally new asset class. Whether you hold a fraction of a single coin or you are simply fascinated by how technology reshapes global finance, this is financial history being written.
The blank spaces on the map are finally being filled in.
They are, and I want to leave you with one final thought to mull over, building on that ghost from 2013. We saw a dormant whale move $40 million today. As we inevitably move into this new era, an era dominated by Wall Street giants like Morgan Stanley, regulated by the United States government, and guarded by massive institutional recovery DAOs. What happens when the anonymous original pioneers, the people holding billions in early untouched Bitcoin, finally wake up? When the original map makers who drew the dragons finally meet the new Wall Street cartographers with their GPS satellites, who will ultimately control the ethos of this technology?
Wow. That is the ultimate question. Thank you for joining us on this deep dive. Keep asking those big questions, keep challenging the narratives, and stay curious.